Hello, and welcome to our third quarter strategy review. We met on Tuesday, June 20th over Zoom. With me was Len Skena, CEO, Vice President of the firm, Bob Toomey, Director of Research, Vice President of the firm. Also, Scott Schill, our new Longevity Director of Law and Planning. And lastly, and not least, was Andy Luckel, who is with Eagle Harbor Asset Management. At any rate, we met, and it was a very good meeting. We started talking about bonds and went all the way through. Of course, we are now past the problem with the debt limit, so we could take that off the table, but we did have some interesting comments on it as well, because it's really just been postponed. With that, I'd like to turn it over to Bob to talk about U.S. equities.
Thank you very much, Dan. So U.S. stocks have really been defying the forecasts of many pundits by continuing to go up, regardless of the reasons. There've been a lot of excuses for why the market's up, and a lot of the negative bears have been saying, well, it's because it's been focused on a very narrow group of technology stocks. To some extent, that's true, but the fact is that the market is still up significantly since last fall, when it bottomed. We believe that it bottomed in October, which we have stated that several times in some of the communications that we have put out to you. And we believe that it still remains the case. Year to date, the stock market's up 14%, which is above average, the long-term average gain. And in this last quarter that we're just ending now here in June, the market's up 7%, at least so far. So it's doing quite well, despite a lot of the negatives. And as the market loves to do, it's climbing the proverbial wall of worry. So, there are several factors, I think, that are affecting U.S. stocks, most primarily, evidence that inflation's coming down, evidence that the Federal Reserve, it's nearing the end of its rate hike program. We've gotten past, as Stan mentioned, the U.S. debt ceiling issue, kick the can down the road, as they always do. That will come up again after the elections, but we've kicked the can down the road for now. And the economy is doing actually much better than a lot of people expected, largely due to continued strong employment and growth in employment. So as we look forward, I'd say following our deliberations, I think as a group, we still remain positive on the longer term outlook for U.S. stocks. We would not be surprised to see some sort of near-term pullback. I'd say a correction of 5 to 10% over the next several months is not out of the question, just because the market needs a breather. It's run very hard for the last 8 months. I'd say other positives relative to U.S. stocks are a broadening in the participation of the various sectors. As I mentioned, interest rate hikes are probably in the process of peaking. We think the Fed is done or nearly done with its rate hike campaign, so to speak, and corporate earnings should start to bottom, I think, by the third or fourth quarter of this year and improve as we go into 2024. And as I've mentioned many times, corporate profits are the primary driver of stock prices. I'd like to turn it over now to Len to talk a little about international equities.
Thank you, Bob. We favored international stocks over U.S. stocks last quarter, and we continue that position as we head into the third quarter. This inclination is further supported given the recent strength of the U.S. markets, as Bob was just describing, and that's going to provide the international markets a runway to outperform in the next several months. We continue to represent international stocks with the large developed economies of the EAFE index, the Europe, Australasia, and the Far East. And we're not putting any of the portfolio in emerging markets at this time. We do also continue to hold an international high dividend ETF that we continue to be quite happy with, and which has outperformed the EAFE index as a whole while providing additional yield in the portfolio. With that, I'll pass it on to Stan to talk about REITs.
Thanks, Len. The REIT portfolio, again, this quarter, we decided to just go with the primary index, which includes, of course, all of the types of commercial real estate, from large office buildings, large shopping centers, and of course, large apartments. We continue to favor it because, again, REITs do pay out all their dividends and must in order to qualify as REITs. And consequently, we get a reasonably high dividend return. We also talk quite a bit about the idea that we might be seeing people coming back to the central cores, to their offices. And I know here in Seattle, there was an article last week saying that 50% of the people were back 50% of the time. At any rate, that is an improvement over what it was. And we expect that we might see some of that going on in other parts of the country as well. So we've generally kept a reasonable exposure to our REIT portfolio. And again, it's something that we continue to generally favor at this time. With that, I'd like to turn it over to Len again to talk about fixed income.
Thank you, Stan. We believe that the Fed is close to raising rates, as Bob described earlier, though we would not be surprised to see an additional rate at their next meeting. The yield curve is currently inverted, meaning that the long-term rates are lower than the short-term rates. And we've reacted to this by skewing our portfolio to the short-term part of the curve, where we can take advantage of these higher rates. We're also representing short-term bonds with an additional fund of high-yield short-term securities, which is a fund that we've used in the past and we expect will bring additional yield to the portfolio. With that, I'd like to send it over to Bob to talk about other changes in our holdings.
Thanks very much, Len. So I think the most notable changes I will discuss here with respect to our small cap holdings, we did remove our position in the XME, which is the Spider Metals and Mining Exchange Traded Fund. The reason we did that was primarily because we had added this as a hedge on inflation, and metals do tend to be good inflation hedges, but we believe that inflation is coming down, it's headed lower, and therefore this position really did not have as much, it wasn't quite as necessary as we felt originally at the time, and we want more of your exposure in the small cap area to be in what I would consider to be more growth type companies. That I think you're going to get more of that exposure in the core holding, the VTWO. With respect to our large cap holdings, none of those changed. We continue to hold a couple of holdings that we consider additive or adjunct holdings within the large cap area. One of those is the Pacer large cap free cash flow companies, high free cash flow companies. The ticker symbol on that is COWZ. We like that because we believe it is positioned to hold many of the largest high quality companies that generate large free cash flow. Over time, studies have shown, and this is anecdotally be the case, that companies that tend to generate higher free cash flow over time tend to outperform the S&P 500. And COWZ has done this over time, and we feel it's a very high quality holding that enhances the value or the quality of our overall portfolio in holdings which you own. We also continue to have a position in the Spider Technology ETF. XLK is the ticker on that. We like that because it gives us exposure to a lot of the largest technology companies like Microsoft, Amazon, Google, Apple, Broadcom, some of the other companies like that we feel are very well positioned to generate above average growth. And over time, because of their generating above average growth and high free cash flow, should outperform the S&P 500. So these are the ways in which we're trying to add value and trying to improve the performance of your holdings, again, through high quality, large cap ETFs like COWZ and XLK. With that, I will turn it over to Stan for closing remarks.
Thanks, Bob. And thank you all for tuning in. As you can see, we are still generally positive on the markets. We are, of course, watching a number of things and paying attention to those. And I think the changes that we made this quarter should put us in pretty good position. However, remember, we always have triggers. These are events that, again, we do not expect to happen. But if they did, it would cause us to take action because they did not seem likely when we met this quarter. First one was the University of Michigan Consumer Confidence Index. And actually that ticked up last month, but it did not go up to the trigger that we had set last quarter of 70. That number was set based on numbers that it had reached over periods of time, trend lines, etc. But even though it's now pretty close, because the index is now 64, we did leave that trigger in. So while we would not be surprised to see it continue to tick up as consumer confidence rises, we don't expect it to go over 70. If it did, it would be a positive trigger for us. Another trigger that we set was looking at the monthly average CPI. Last quarter, we were concerned about that going over 10%. With what's been happening this quarter, this last quarter, we are now looking at it as a positive trigger if it gets down towards the Fed's, what the Fed is looking for, or the 2% rate. We did not say it had to go to 2, but if it went under 3, that would also be a positive trigger. The one negative trigger that we put in was one that we've talked about before. And actually, in the history of the firm, it was the first time we ever pulled a trigger, was when the rating agencies lowered our U.S. government bonds to below AAA. And we are a little concerned that that could happen again. Again, it's not happened, therefore it's a trigger. But if they did decide to take into consideration all the craziness that's going with Congress and so on, and saying it would be difficult for them to really properly govern, which is actually what happened last time, and they did decide to lower our rating, we definitely considered that also a negative trigger. So with that, I'm happy again that you tuned in. I hope you tune in next quarter. And until then, have a great summer.